All right, well, good evening to all the South Africans streaming in at the moment. Welcome to the Quintessential Show. It's good to be with you. And yes, today we are talking finance. You know, I think we're going to start calling it, what is it today? Wednesday? Wallet Wednesdays. How about that? I think we should get more people joining us, for Wallet Wednesdays. We are live on YouTube, Periscope, Facebook. So if you are around there, say hello. I see a lot of questions already in the YouTube that are demanding answers, so that's going to be quite something. My name is Quintus. It is good to be with you, and as you can see today, our topic is investing under lockdown, which we said we wanted to get kind of like what the financial crater is and kind of measure it, what is happening in terms of financial markets around the world really, but more specifically South Africa, because we believe that the economic ramifications of this COVID-19 pandemic and the subsequent lockdown and level 4 continued lockdown is going to be quite sizable. So we thought, let's get in touch with the guys that have been involved with financial independence of South Africans for quite some time now, since about 2014. I'll bring him in just a second. I just want to take a look at a small thing here that says they have been called the best fintech, best startup and most innovative business and top online stockbroker by a plethora of award bodies. They are very much the pioneers of fractional share ownership in South Africa, and according to them, they have just turned a profit. By the way, Purple Group, the owners of Equities, say they have generated a profit of 0.8 million rand compared to a loss of 6.2 million rand in the comparative period, an improvement of 113.6%. And apparently the group revenue, Purple Group, the revenue increased by 15.2%. Today we are talking to the man at the helm. It's Purple Group CEO and Equities Founder, and that is Mr. Charles Savage. Mr. Charles Savage, how are you doing?
I'm very well, Quintus. Thanks for having us on, and thanks always for the interest, and very lucky to be on and taking questions from your audience.
Yeah, listen, I'm one of those guys that's at the campus radio level found Equities, and I was sitting at campus radio going like, this is the fractional shares. This is exactly what a student needs. It's one of these things. So you eventually start thinking, what about my finances? And you eventually get into it. So, since then though, it's been up and down, and there's been rocky roads, but you guys seem to have become profitable. So tell us about the journey towards getting Purple Group profitable from the period between 2014 to 2020.
Yeah, I mean, at the start, it's interesting. We never worried about profitability when we were building the business or designing the business, which I have to say it's the first time I've ever built a business where the income statement, if you like, came last. It was more important that there was a deep sense of purpose in what we were doing, that sense of purpose inspired the team, and then that the product that came out of that inspiration resonated with our customer audience. And very early on, I don't know if you were around when we ran the sort of test game, which was pre the live launch. We ran a game and there were 2,000 game players, and we had 1,800 complaints about how difficult the platform was. So the name wasn't resonating just yet. But the one thing that came, there were lots of things we needed to fix, which was easy to do. But the thing that came out of it was this incredible excitement about what investing might look like as a result of Equities. So when we built the business, when we eventually got around to the income statement, in order to marry this deep sense of purpose with the product and then the pricing, we had to back ourselves into a break-even where we were bigger than the largest stockbroker by customer numbers. And that number we guessed at about 100,000 customers, active customers. And we got it wrong by about 10% in the end. I think we broke even with about 110,000 active customers. So we were right. The other thing we got wrong is we said we would do it in 3 years. That's just standard business plan talk. You can't say longer than 3 years. But if we consider the period that we launched in 2014 to today, this has been the worst investing market I've ever seen, and I've been around long enough to have seen some bad ones. And to consider that we built an extraordinary business in terms of customer numbers, the love and passion that is expressed by customers for the brand, the trust that they place in us in such a short period of time, and now to be profitable, which is less important to me than you would think. I mean, it's much more important that our purpose resonates with our customers and our customers are passionate about our business. Staying focused on that will lead to good profits in time. But for now, profitability doesn't seem that important, especially if you consider the world we're living in today.
Yeah, how many active users are you guys now actually sitting at?
So across all of our platforms, and we run a few. So we've got ours, we've got a Bidvest partnership, we've also got Satrix Now partnership. So, and then we have a institutional platform in Rise, but excluding the institution for a second because that's cheating. But with all the retail platforms, we're over 220,000 active accounts, and that means we've got somewhere in the region of 150 to 160,000 active customers. So on average, customers have about 1.4 accounts with us, because as you know, you can have a tax-free savings, you can have an RA, you can have a US stockbroking, very soon an Aussie stockbroking account, and who knows what next. So about 150,000 active customers, 220,000 active accounts, and growing at a rate that is keeping us up at night.
Yes, I would imagine. Let's talk about COVID-19. Obviously, this is another one of those things, that took us by surprise, and threw the stock market for a loop up and down. And now things are rising once again, thank goodness, especially for people who have TFSAs. The thing is, though, that there was a surge of traffic, as I understand, with Easy Equities, and there's been some technical issues on the platform itself that you've emailed to us and kind of explained. But do tell me and kind of walk me through what happened in terms of the technical issues. I mean, even today there were some technical issues on the platform itself, but I believe that was on the hosting side of it. But how has the lockdown treated you guys in terms of technical issues?
Yeah, I'm an IT guy, so I've done a lot of. My first job in the group was CTO, so IT's in my blood. And when we budget for growth, we budget for 100% growth, which means we're scaling our systems 100% ahead of the business all the time. Which means that as long as we grow at less than 100%, everything's going to be fine. The problem that happened is that we were growing at just under 100% into the February year end, which you can see in our results. And then March and April, that growth went from 100% to 400% in those 2 months. And the wave of customers was just overwhelming. And then, when you're behind the curve and having to scale a business that's 300% behind its budget in terms of the scale, you've got to take some shortcuts, and you've got to take some risk, and you've got to implement some tech that you haven't probably tested, and you've got to just, you're doing your best to keep up. And you've got to consider we're trying to keep up in a world where you can't go face to face with your suppliers. Your suppliers' infrastructure is under more pressure than they've ever experienced. So hosting infrastructure has never been more utilized. Home internet access has never been more utilized. Data has never been more utilized. And at the end of that, all of those channels or pipes sits Easy Equities, and we're getting blamed for everything. And, we're accountable for a lot of it. We were surprised by the growth. We couldn't have budgeted for it. And I guess the trust relationship with our customers is this. For us to keep a low-cost platform, we can't build a platform that is waiting for millions of customers. We've got to strike a balance between growth and infrastructure. And if we keep getting that right, we'll keep being able to provide you the best low-cost, easy platform. So the bottom line is, when customers pitch up at the rate they do, we're going to be under pressure, and we have been. But one of the benefits of being under pressure in lockdown is that innovation does mostly come from scarcity. It's something I believe in fundamentally, and the amount of innovation that has been accelerated in the 6-week period has just been extraordinary. And we're very, very close to a final infrastructure implementation. If it all goes well, early next week. But let's not commit to early next week. Let's say end of next week. We'll have an implementation that we think sets us up for the next phase of growth, which is well beyond 200, 300, 400%. So it's been a struggle. Our customers have been amazing. I mean, the patience with which they've dealt with us, the support that they've given us has been incredible. I think one of the things that also caught us by surprise, one thing we've been true to is that we're creating an investment platform. The problem in crises like this is everyone becomes a trader. And we never built the platform to have a trading capability. Otherwise, we would have graphs and charts and technical analysis, and we would have live prices and a whole lot of functionality.
Yeah.
But the problem is you've got to meet customer expectations. So the expectation that is out there is that I'm going to use Easy Equities to trade. And so it's not their fault. We've got to fix it, and we are. And very soon we'll be an environment that is stable. Having said that, the environment on which we operate, the hosting providers, the data pipes, everything. There's lots of kinks in those channels, and everyone's affected. I mean, I've seen big service providers going down quietly. The difference with us is there are just literally thousands and thousands of people arriving every single day, and no one's going to be quiet about us being down for a couple of seconds.
Yeah, I like how you say that everyone has become a trader, but things like, the oil price, jumping all over the place, that's not very helpful, because now everyone's taking a look at, should I be buying something like that Standard Bank exchange traded note that covers the WTI, and must I now get some oil shares, and maybe I should sell and buy and all that kind of stuff. So I totally get where you are going with that. I do want to bring up a question that Stealthy Wealth asked in the YouTube comments. He says that, have you seen anything noticeable with regards to people cashing out their investments to get them through lockdown? Do you guys have an eye on how many people are taking huge amounts of money out of their accounts to just survive on?
This is probably the biggest surprise. So everything that I was taught and have experienced in every other crisis is that when you have a crisis, investors sell their assets and move into cash, and then inevitably they lose trust in financial institutions or all institutions, and so they take their money and put it in a mattress. That's what what we've seen. Now, what have we experienced? Never ever seen inflows like this before. As I was saying earlier, 300 to 400% greater than the inflows that we saw in February, and outflows have only gone up by about 30 to 40%. So we've got 400% growth on inflows and only a 30 to 40% growth on outflows. So people are seeing the opportunity to go and buy these very depressed assets. And as a result of that, I mean, we're 7 weeks in now, they've done very well. I mean, the average entry on Sasol on our platform was 52 Rand. I don't know where we closed today, but it's, somewhere in the 80s, I think. We saw Capitec drop down, and lots of buying action there. We've seen oil drop down, and there's been lots of buying action. So I've tried to understand what's different about today's investor and yesterday's investor, and things that I've come to realize. The one is that access to information has been democratized. So it doesn't, in the old days, and old days aren't that long ago, I'm not that old, but the traders had access to the fastest information. Via their Bloomberg screens, via their call boxes, via their network, they would have access to information, and there was an information arbitrage which allowed them to have an advantage over everyone else. That's gone. So everyone's got access to the same level of information, and in fact, an investor on Easy Equities got as much access as Trump has to what's going on around COVID. So we're much smarter, we're much savvier, and we're therefore much more empowered to look after our money than ever before. The other thing is that I've never seen an investment platform with such a young demographic. So the average age of our investors is 34 years old and getting a year younger every year, despite the fact that we're 5 years older. So you would expect our customers to be getting older every year. And that means that there is a wave of young investors joining us. Now, the one thing that's commensurate with age is risk profile. The younger you are, the more capacity or appetite you have to take risk. And that realization is thanks to guys like you, thanks to guys like Stealthy, thanks to all of the educators who've been pushing financial literacy and education around the fact that, we're not in this for green on our statements tomorrow. Whilst that makes us feel good, and everyone who wants to see green quickly, what we're looking for is a lot of green a long way out. And so this investor community are seeing the opportunity today and thinking about what that could be tomorrow. And when they're thinking about tomorrow, they're thinking 5, 10, 15 years out. So those are the two things that have fundamentally shifted the needle for me around today's investor versus previous, investors that experienced other crises. Super engaged, super connected and in touch, and also have got a risk appetite that is much greater than what I've seen before. I mean, typically stockbrokers and financial services practices like ours, the average age of customers is closer to 55.
Sheesh.
And so you can imagine what a 55-year-old is doing in a crisis. They're
buying gold.
Exactly. They're going to be cashing out. They're going to be buying safer assets.
Yeah.
But we don't have, whilst we have a good portion of older customers, what we have is more than 65% of customers who are under the age of 35. And so what they're doing is seeing the opportunity in buying assets at these prices.
Yeah, so that was the long form answer of saying that you haven't really seen people cashing out. You've rather seen more people getting involved and starting to trade. But, that's what, to bring Stealthy into it, was saying in one of his blogs the other day. And that was, go on as if nothing is happening. And you should just trade as though you were usually trading if the world was open, type of thing. So I mean, that's definitely changed my outlook on it, because some people might have, especially in a tax-free savings account, been like, wow, should I be putting anything in there, because I might not have a lot of money left for the month or the year if this COVID-19 thing continues. But even as a business owner yourself, and obviously you guys have an office to go into, and COVID-19 has obviously sent us into that lockdown. In terms of the physical space of Purple Group and Easy Equities and the rest of your guys, what you own, how has that specifically impacted? Has there been anything about maybe thinking of letting people go, or is everything okay? You guys haven't had to do any of these schemes where suddenly people are, going to UIF and stuff like that. Tell me now, in level 4 lockdown, what is coming up for Purple Group in terms of the physical space where you guys do business?
So we started on a journey almost 3 years ago to pursue Agile as a framework for our staff. And in pursuing that Agile, we had a dream to be able to work from anywhere you wanted to work, in the teams that you wanted to work with, on the projects that you wanted to work. And all that COVID has done is accelerated those plans. So rather than a 5-year journey, it's here and it's now. So we're pretty agile. So no, we haven't had to. Fortunately, there's been no reason for us to think about cutting costs or reducing staff. In fact, I did 4 interviews today, and we're hiring, and we're spending more on IT infrastructure. So no, it hasn't impacted us. It obviously, we are a 100% digital business. We don't have a physical store front. The question that comes from this, though, is, do we need offices anymore? And if we don't, then what do we do? What are we going to do about that physical space? Do we give it to customers, or do we just give it back to the landlord and put the money into the income statement? But the bottom line for us is, it's accelerated our dreams and vision of being completely agile and allowing people to work wherever. And the question that's going around in my head is, what are we going to do about that when we're allowed to go back? Are we going to go back? Is that the most productive way to work? Our experience so far is that this is a more productive way for us to work. But I think we're living in a little bit of a false economy, in that people are putting more in this crisis because they're worried about their job security. They want to make sure that everything moves forward. And maybe when the crisis is over, the productivity will drop off. But so far, the productivity levels have been much higher than we expected, and in fact, the business is moving forward faster than we expected, than we would otherwise be moving forward if we were all sitting in offices looking at each other all day.
Yeah, but the pandemic did kind of put a pause on something that you guys were rolling out, and obviously you made that decision so that, I guess you can talk to us about why you guys decided to put EasyProperties on pause, because as far as I understand, you were going to be rolling that out quite early on in the year, but the pandemic delayed that to a degree. But walk us through EasyProperties. Now, this is a brand new product that you guys are going to be forwarding, and people are looking forward to it, as far as I can understand. Tell us how this differs from real estate investment trusts. Is it the same thing? What is the product, in fact, and when can we expect it?
Yeah, so let's start with when you can expect it. As soon as CIPC opens, and we can get those businesses, those special purpose vehicles approved, then, and typically it takes 3 to 4 weeks. So about 3 to 4 weeks after CIPC opens, we'll go live. Then, is it what What is it? I mean, essentially what it is we take a selection of properties, the same properties. So let's just say units in a development or units in a block of flats. So they all have the same physical address, if you like. And then we put them into an SPV, and then we sell shares and fractional shares in that SPV. And the costs, well, the income minus the costs is the dividends that we'll pay out. We'll retain about 15% of the cash for emergency. So, a COVID hits and we don't get rental income and we still got maintenance costs. But essentially, it's giving you direct ownership exposure to a range of capital growth and or interest, yield plays in the property sector. And we've partnered the biggest residential book in South Africa. It's a privately owned book, but it's the largest. It's bigger than any institution's residential book. So we have unlimited supply. What we want to do is focus on the demand and getting the product right before we unpack all of that supply onto consumers, because we're sure, like with Easy, there'll be some tweaking in the final business. But the bottom line is we did a questionnaire, I think it's almost 2.5 years ago. And in that questionnaire, we said, look, we understand that listed markets give you access to a lot of assets, but what's missing? And our expectation was crypto was going to be top of everyone's list. And funny enough, crypto was number 2, which was a big surprise. And number 1 was access to residential property. And then we surveyed directly. We called a couple of the applicants, people who complete the survey, and asked them why. And the answer was so interesting, but easy to understand with hindsight. I mean, what people were saying is that they can't afford to live where they work, and there's no access point for them to purchase parts of it so that they can save up to own a flat in Sandton. And we were like, well, we can solve that. I mean, we've solved that in the share market. 5 years ago, people who couldn't afford Naspers couldn't buy one. Today, people who couldn't afford them 5 years ago are stacking them up now. So why not do the same thing with properties? Why not create an access point an affordable access point where we vet the property so they're safe properties, good properties, and allow people to save up in fractions to own residential property. So, and it was overwhelming demand. I mean, 60% of customers who answered it put residential property as their number 1 desire. So what we like about it is it takes us out of the pure digital space where you can't touch and feel a share, and we love the experience that this could bring to the brand of actually touch owning, kicking, and visiting property, what you own. And I think that's going to be a really opportunity in South Africa, and I think it's going to redefine the landscape in property, and I think it's going to be bigger than Easy Equities in time.
Sure. Wow, that's quite the prediction. We'll see if that pans out. So yeah, that I've seen a couple of people that kind of already, because I remember there was a quote that you said to someone in the media saying, imagine if you could be a shareholder in a physical Porsche, and then you like won 365th share of the Porsche, and then you could be invited to drive it. I mean, that's not exactly how these things will kind of pan out, because I see there's a question saying that is there a component built into the property fractional shares that should one buy into a property, say at one of the properties you guys have, one could holiday there for a week or so. It's nothing like that. It's just the profits and the dividends out of what the property as itself makes.
Yeah, we are looking at residential hotels, interestingly, and we'll see. Right now, not the best time to be launching a residential hotel, but we are definitely going to fractionalize access to those. In the roadmap is a loyalty program, and we're still thinking about what the benefits of the loyalty program would be. But some of them will be very physical. So we want to use the physical presence of those buildings. So, exactly that point. If we've got empty bed nights in a hotel that we own, why not put our customers in, the owners, why not allow them to have that access on a lastminute.com basis? So we are thinking about that, marrying this digital and physical world. So and for that reason, it's a very different and interesting opportunity for us, because we do want to marry digital and physical here. We want to make sure that this is an experiential brand where you can touch and feel it. So lots of exciting things we're thinking about. To start with, we need to list properties and secure the supply and demand and build a profitable business model and then worry about how what else we do with it.
Yeah, I want to go back to something you said earlier about this kind of creative pressure that's currently happening. Especially because it seems like Easy Equities was born for a time like this very digital trade-like site, and I like that whole thing of feeling like you're in a pressure cooker where we now need to get creative because there's people that need to now start their investing futures, but in a market that's being scared off by pandemics, but now that's rising once again. I just want to know for beginner investors, because there might be some people watching this who have missed some of the terms, who just don't know what's happening, and they're kind of feeling a cold shiver every time they think about, listen, I want to put my first money into something in terms of an investment. And I imagine you'll see the same with EasyProperties. For beginner investors, in terms of the education side, I believe you guys have something that will educate people, especially about tax-free savings accounts. Talk to us where you would begin in educating yourself when it comes to investing.
So I'm not like everyone, but let me tell you what works for me. I'm very experiential. So everything that I've learned in my life, I've learned by standing alongside people who knew how to play the game. It doesn't matter what it was. It was school or being CEO of a listed company or learning how to invest. All of the things that I've done, I've experienced by standing alongside people that are better than me. And so for me, the best way to understand investing is to start and to experience it, and then surround yourself with people that are better at it than you. And it's why we put social media at the center of our DNA. I mean, as you know, everything you do on the platform you can share and boast about. And the reason we did that is so that other people could find you and latch onto you and use you as their educator, because that's how we create exponential outcomes. Is that if every customer educates one more customer, at some point this becomes a snowball rolling downhill, and not in very long we'll educate the whole of South Africa. Mm-hmm. So for me, it's an experiential thing. We encourage our clients to educate their friends and family, and the key thing for everyone is you can start with $5, man. You can start with the cost of a cup of coffee. You don't have to play with demo money, which is there, although it was removed recently to give some value back to the platform in terms of speed, but it'll come back soon. But the point for me is you don't really feel or learn anything with play money. Yeah. If you take 10 Rand and buy 10 stocks, 1 Rand of each stock, and start to have discussions around those stocks, why they're performing, why they're not, start attending some AGMs online, start reading some annual reports, read a few books, ask questions on Twitter, attend our online university, write the exams, watch YouTube videos, attend this kind of stuff. I mean, it's endless, the options to educate yourself. And, for me, it's not about dedicating hours and hours. If you dedicate 10 minutes a day to your financial education, within 6 months, you're going to be more literate than 90% of the financial advisors out there.
Yeah.
We're not building bombs to blow up buildings here. This is not complex stuff, man. Mm-hmm. This is basic. Finance is basic. I mean, my youngest daughter started when she was 5. She's now 12. She gets it, and I promise you, she's never read a textbook. I haven't made her write an exam. She's experienced it in her portfolio. She prefers brands that she understands, like Disney. She loves Purple Group because she thinks I work for her and she's right. But she's learning through those experiences, and by the time she turns 18, there's nothing to teach her anymore. Absolutely. She's now seeing her first crash, which is interesting. She's had lots of questions with me, like, what does this crash mean? Is it going to recover? Am I ever going to make money on my portfolio again? Those are great questions, hard to answer a 12-year-old. But bottom line is, for me, get started, experience it, surround yourself with people that are smarter at it than you, and ask lots of questions. I mean, there are no stupid questions in finance. Only stupid people who don't ask questions.
Yeah, I thought, at the beginning of my investment journey, I started reading American Wall Street books because, your business teacher shows you Wall Street, the actual film with like Michael Douglas in it. And then you start thinking, damn, that's what I want to do. I want to be the guy on the Wall Street floor, But then you start reading the books and it becomes much more boring and systemic, So eventually you start seeing a word like exchange traded funds pop up. And then you start researching, where can I get exchange traded funds in South Africa? And, we on this channel, we've actually spoken to both Charles and we spoke to Candace Payne as well about exchange traded funds and what they are and how you can invest them in a tax-free savings account. But Easy Equities did make it a bit easier. Now, I'm not giving any financial advice here, but we do have a quintessential basket on Easy Equities. I'll quickly go to a browser window. Just stay right there, Charles. I just want to show that this is now under our quintessential basket on Easy Equities. You go to Invest Now on the platform in the tax-free savings account, Invest Now tab, and then you go to baskets and you'll see the quintessential basket is there. And it's kind of like a little bit of an intro in terms of, these are the kinds of exchange traded funds that are more likely. And it's a very risky thing. So look, if you're a millennial, I would say look into it, because if you have a 30 to 40 year horizon to invest in, then you've got a whole bunch of risky stuff here. But sometimes people just need the push. And as you can see, it's got a world ETF, it's got some South African stuff in there. All of them, though, are sitting at the positive green side, 14% up on the world ETF, 16.27 on the South African one. We're looking at Quality South Africa's even popped up, emerging markets, and even a fourth industrial revolution global ETF in there. So sometimes people do need, Charles, just a little bit of a nudge, a little bit of a push to get into the investing game. And I think what you guys have built is a good start, because I would have never been able to find some really scary platform back in the day. But I've actually been to a couple of these new websites. Or I don't know if they're new or not, but you go to some of these websites where you can do like credit swaps and all of that kind of stuff. And Google actually puts a tab above the site saying this is like a high risk investment thing. So you guys, have you ever been told you need to put that on your site or something like that? Because I've seen a lot of those trading websites where people usually flock to go do day trading have these warnings on them. Do you foresee that happening one day?
No, not for equities. You have to have risk disclaimers, and ours are appropriately placed. But in the derivatives world, and we run a derivatives business, and as a result of that, and I've been in that business, for 20 years now. So let me tell you the stats. 80% of people who trade derivatives lose money. 20% of them are successful, but 5% are successful enough to make a living from it. So for the other 15% that are successful, they're sort of washing their face. It's a bit of fun. They make a little bit of money, but they don't make enough to live by. But, and then 1% make a lot of money, and those are the books that are written. Those are guys like Taleb and others that have done exceptionally well. But trading is like every other career. How many people get to be CEO? How many people get to win the PGA? How many people get to play in the Super Bowl? And it's all going to be in that 1 percentile. So trading is like everything else. The risk warning should say this is as difficult as every other industry to perfect. You're not going to get good at this unless you're in that top 1%. And when it comes to shares, the focus on risk in the industry has been too high, and to the extent that it's actually scared off a lot of customers. And what we haven't focused on is what is the risk of not investing, and which is the greater risk? Taking some investment risk as a youngster and learning the game and understanding it and taking control of your financials, or not investing in your financial future. And the latter is by far the most significant risk that we face as individuals. I've built an investment business, but I'm 46 years old and it's only 5 years old. So I only got to this, I only built it when I was 41. I dream about a platform like this being available to me when I was 16. And paying my school fees with 20 Rand and not 20,000 Rand. And for me, the biggest risk that anyone can take is not getting involved and engaged in controlling their financial future. You don't outsource your kids to other people, and your finances should be the same. You shouldn't outsource your finances to anyone. It's not difficult to do, and the risks are not as high as presented. But with anything, if you fail to understand something, then you're going to increase the risks. The more you understand, the less risks you're going to take. So, too much emphasis placed on risk. They must be there for the uninformed, but they should, if we could do some AI, if you're browsing the site and we understood your investment IQ, we should make them disappear.
Perfect. Cesar Keller says on YouTube, are we able to register kids on Easy Equities? I believe tax-free savings accounts, you can register a child. Can you register a child as a user on Easy Equities?
Yeah, you can. South Africa, interestingly, is only one of the few destinations in the world that allows kids to have stockbroking accounts. In the US, you can't. So unfortunately, you can't open an account for your kid overseas, but you can in South Africa.
Okay, perfect. All right, now I saw that you guys implemented a noteworthy option to donate to the Solidarity Fund on the platform. Every time someone invests, it asks, do you want to give to the Solidarity Fund? In terms of the economy, though, that is a noble thing, and I'm a little bit apprehensive, and I get a bit nervous about just carting money off to government and suddenly what they're going to use it for. But you can obviously talk to that. What are the checks and balances in terms of sending over to the Solidarity Fund, and then just a word on what you think about the future of the economy as we maybe emerge out of the lockdowns, but start with the Solidarity Fund.
Yeah, I mean we were building this Donate for Good a long time before COVID came around. And we were building it because our customers said they wanted to be able to do social good on the platform. Now, there just aren't enough social do-good companies on the JSE. The investable opportunities in South Africa for social good aren't as many as we'd like. So what we did is we built the next best thing. We built a way of giving to charity. And we'll change the charities from time to time. I mean, to support solidarity for now is by far the best thing that we can do. In time, that'll change, and we'll find other causes. Our customers will lead us to new causes, and we'll help support and create a much more sustainable model for charity. What we want to end up doing is that actually the charity, 80% of it will go into a fund for that charity, and we'll build and only 20% to their cash flow. And then over time, the fund should be able to take over the cash flow. So it's a sustainable way of doing charity. But for now, it's just Donate for Good and it's solidarity, and we'll switch it out with other charities in the future. Your question about the economics of South Africa post-lockdown, I mean, this is the stuff that's keeping me up at night. My business is really just doing superbly well, and it's not consuming as much time as it would normally. My mind is much more worried about South Africa post-lockdown. And I feel like we're moving slowly, or not taking the economic impact seriously. But at the same time, we still don't understand enough about this virus to just let people, come out of lockdown. So what I've been thinking about is, what can we do when we get out of lockdown, and what can we do now? And I think businesses now, they have to focus on sustainability, not profitability. They need to cut their expense base back to the point where they're sustainable, not profitable. So that would be my call to CEOs of businesses. You have to save jobs that you cut jobs that you and cut costs that you're sustainable, but don't target a profit margin. I think shareholders will reward you in time. The second thing is that what businesses have got to do is they've got to use this lockdown opportunity to radically change their digital strategies. I mean, we're lucky in that we built a business that never had a storefront. And so everything we do, we've got to think about how we can do it online. I think there are too many businesses that are digital or purport to be digital that still rely on that physical footprint to do business when their digital fails them. And what that means is that in the result, their digital is just too weak. It's not truly digital. And so I think 90% of South African businesses, in fact more, 95% of South African businesses fit into that category. They need to look at how their digital platforms failed them in this lockdown, and they should use this lockdown as an opportunity to batten up the hatches and deliver a much better digital offering so that they are better prepared for the future, because the future is going to look like more like digital. In fact, I think this is the tipping point for digital on the continent, not in the rest of the world. It's been coming for a long time, but in Africa, not so fast. But I think this is the tipping point. And then finally, I think, as consumers, when we let out, buy local, buy local goods from local producers, from local manufacturers, from local stores, and let's rebuild our community and our country by buying the goods that we need from the people we know.
Yeah.
Because no one else. The Chinese aren't going to come in here and save us economically. Neither are the Americans and neither are Europeans. We're going to have to save ourselves, and let's spend our money on saving ourselves. Let's support our local brands. And one of the things that I got wrong as a youngster is I always used to I believed that that international businessmen were better than South African businessmen, and international manufacturers were better than South African. And the truth of it is we had an inferiority complex. I had an inferiority complex about how good we are. We don't need to be, we are as good as anyone in the world at producing anything. And the bottom line is that we need to believe more in ourselves and buy more of our local produce. And when we believe in our own products enough, I promise you the demand for our products to be exported will also increase. So I think we've got to focus on our own industry, our own products and services, and almost don't buy anything international unless there is seriously no one producing it here. And if no one produces here, then that's an opportunity for an entrepreneur to go and do it.
Yeah, I've always been, very fond of the idea of fractional shares as you guys kind of introduced them and pioneered them in South Africa, because that's what I thought. A lot of our people who are working class citizens don't have the kind of money to buy, like you say, a Naspers share at what the current share price is. And so the fractional share thing and the digitization of the entire process seems to be something that is more of a solution. But many people get scared off by, especially, things that are being advertised like that, because they think there must be some sort of catch. But like you say, the digitization of industry, and it's starting with the banking sector, and we can see it, that new banks are starting, they don't need physical space, and suddenly all the other banks are trying to now pander to you and say, listen, we've still got physical space, we have to close a couple down, but here's our online thing. And they're having a real problem and a hassle from taking their legacy software and putting it into this new digital future. And it seems to be like putting a round peg in a square hole, and it's not working out for them. And that's why I'm thinking, the space has been thrown open, and Easy Equities is but one player, but a very, very advanced player at the moment. But let's talk about where you see it going in the future. Like Easy Equities and EasyProperties in the next few years. But I want to kind of preface this with some of the questions that we've gotten on the line, because some people have asked in terms of GT247, which is another property that the Purple Group controls. What is the appetite of you guys putting GT247 and Easy Equities into one platform, and then the live prices into Easy Equities, and like we spoke about, maybe making it more of a trading thing like you guys have seen. What does the next 5 to 10 years look in terms of the platform?
Yeah, GT will never put GT inside Easy. GT, I think, is for it's a niche market audience, and traders. If you think about the statistics I gave you earlier, about 80% of the people losing money, what that means is 80% of your customers are gone every year. So you have to replace them. And it's not a great business. It produces, it's where my career started. The tech that's required to support traders is challenging, but it's not a business I'm passionate about building. And it will, as a result of that, it's going to play a less and less shining role in the future of the group. Easy Equities has to keep sophisticating itself, but not at the expense of making it difficult. We've got to keep this razor sharp focus on ensuring that when we do something sophisticated, we still present it as easy. And that is the challenge that we've got to do, because if we over sophisticate the interface, we'll disintermediate the first time investor, and we've got to remain true to what we started out to do. We started out not to steal customers from Standard Bank or ABSA or any stockbrokers. We started out to create a new culture of investing for first-time investors. And the platform has always got to feel welcoming for them. They must never feel intimidated by it. So as our customers get more sophisticated, guys who've been on the platform for 5 years are now sophisticated. They're demanding more functionality. We must deliver that, but we've got to keep it easy. And so what you'll find is that the future will look a lot like Uber. There will be Uber van, there'll be Uber Black, there'll be Uber whatever, to cater to different market segments, but always with a razor sharp focus on ensuring that even when we make it sophisticated, we keep it simple and make it easy. And we're going to fractionalize everything our customers want to own. And I see us going into physical commodities. I see us going into bonds very soon. If you look at what's happening on interest rate curves now, a great time to be fractionalizing bonds. And I see Satrix are launching a bond ETF, I think, next week. So that's going to be an exciting product in the current environment. I see us playing into Africa much more seriously. What we've done in South Africa, we must replicate in Africa. That's our real opportunity. And as we do, we'll expand new products and services that are meaningful to that market segment. So we're looking at East Africa. They've got an incredibly strong corporate government bond market where you're getting 12-13% kind of yield on a very stable currency basis. So that's where I see us going over the next 5 years. For me, it's a 10-year play. So I'm not planning on going anywhere for 10 years. But the real play, the real value that we create, the real magic is 30 years out. When these 35-year-olds graduate and retire, and they telling their friends and family about where it all started, Easy Equities is going to be in that storyline. And I just wish with all my soul that I was there to see it, because I think that's where the real magic's going to be. We're creating hundreds and thousands of Warren Buffetts. And in the outcome, the economic impact on that, 30, 40 years out, is going to be something that we're all going to be very proud to have been part of.
Yeah, that's the one. Standwa Uza on YouTube says, agreed, Africa is the future. And I think with that kind of sentiment, I think Purple Group's shares are going to be skyrocketing after that one. You've been Trumpian over here where you're inflating your own stock price. But you know what? I think you need to look to media as well. Some of us small time media guys, we need some fractionalization of, I don't know, some way to fund us and get us out there and into the media scope, because media is also one of those industries that is suffering at the moment. Some newsrooms are thinking of closing down and letting people off, and so I'm a bit afraid for media in the country, and I'm thinking, how can we now take it into the South African future, just like an Easy's taken fractional shares into the South African future. So I, you've got my information, Charles. You just let me know when you need it. Andrew Fenwick says, well done to the team. Akona Malinga says, Charles mentions expansion into Africa. Are you considering onboarding foreign nationals with FICA to access South African markets? For now, I understand they have USD accounts. Do you know what that's all about?
Yeah, I do. I mean, the JSE makes it really difficult for foreigners to own shares, and then it's not just the JSE, exchange control and a myriad of laws. We must work at working with them to change that. And the demand is growing, and certainly as we go into Africa, the demand is going to grow even more, because South Africa's got some really spectacular listed companies. And in a lot of the African markets, their universe is sort of 10 or 20 stocks. That's it.
Sheesh.
So we have to solve that. We don't have a solution right now, but I will say that the JSC are working very closely with us on a couple of initiatives, and that's one that we've got to try and solve in partnership with them.
100%. Charles Savage, thanks for joining us here on the Quintessential Show tonight. I think that basically covers the first of our many, many talks we'll have into the future, as we know, because that's the thing. I think this is what this lockdown has done, and we kind of covered it in whether or not people were cashing out. It's more like now people have had the time to actually research their financial futures and start to think, okay, so which is the platform to do it? And I've seen that in my friends' WhatsApp groups. They sit there and they're just like, okay, guys, this is it. Now we need to actually start working, because tomorrow an industry closes down, and that's that. We need to see what can be put into the future. But Charles, thanks for joining us. I hope you'll join us again at some point. But thanks for joining us on this iteration of the Quintessential Show.
Cool, Quintus. And I just want to say a special thank you to you. It's guys like you and platforms like yours that are creating an exponential force for us in terms of customers. So your challenge in terms of how we solve the media, I'm going to give that a lot of thought and see if I can repay you with some ideas. And then to your listeners, thanks for stepping in. I mean, I think Cyril was on talking, or somebody more important than me. But the bottom line is, I really appreciate coming onto these platforms, and I'm available anytime you want to chat. So thanks 100%.
Very much. All right, take care. Let's go see what they've been saying about level 4 lockdown quickly. All right.